It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So today we're going to discuss trade deals. There's been a significant number of trade deals that have now occurred, the most recent one being with South Korea. In fact, South Korea has agreed to a 15% tariff on goods entering the United States with a 0% tariff to the goods going into South Korea. This is a very good deal for the U.S. Also, South Korea has agreed to invest $350 billion on investments owned and controlled by the United States. Part of that is they will purchase $100 billion of liquefied natural gas or other energy products. And probably most important with this deal is for the first time ever, South Korea will be opening their markets to U.S. products that were formerly restricted or not allowed either through tariff or non-tariff barriers for U.S. companies to do business in South Korea. This is, again, a tremendous deal, and it echoes very much similarly the deal that was completed recently with Japan and the EU. In fact, with these deals, you're starting to see a similar pattern, and even those that are not Trump supporters or very reluctant Trump supporters are being forced to agree that these deals are tremendous for the United States. The Japanese deal, for example, Japan will invest $550 billion into the United States. There's a 15% tariff for goods entering the U.S. from Japan, and U.S. goods into Japan have a 0% tariff. Also, more importantly, the Japanese market will be open to U.S. products that were previously not allowed or restricted or heavily limited in terms of access to the Japanese market. For example, I've shared this on a previous show that over 90% of cars driven by Japanese are built by Japanese car companies. It was against Japanese rules to have a U.S. car dealership. In other words, you couldn't sell U.S. cars in Japan. Well, that is changing. Obviously, Japan has sold millions of cars into the United States over the last number of years. What's interesting about the Japanese deal is they're doing a joint venture with the U.S. where they're funding the $550 billion into strategic sectors like semiconductors, energy, shipbuilding, and pharmaceuticals, and the U.S. will keep 90% of the profits. This is interesting because it's a long-term economic joint venture where both parties benefit, the U.S. to a great degree more, certainly, but the reason behind it is simple. The U.S. is the largest market in the world. It's the largest economy in the world. In fact, we still account, despite our challenges, we still account for about 50% of gross domestic product or economic activity in the world. So we are by far the largest economy in the world. And if you are a manufacturer, say a Japanese car manufacturer, you want and need access to the U.S. market because that's the biggest one. That's half the world's economy. What Trump is doing is, he's often been said, the buyer is always right. He's using the economic strength of the U.S. to negotiate far better trade deals than we have ever seen before. This is groundbreaking. This is earth-shattering change that we're going to be experiencing over the next few years as this economic development, as these investments start rolling into the United States, and U.S. companies are going to be allowed to sell products into these other markets. Frankly, this is massive. Another one from the Japanese deal, Japan's committed to purchasing over 100 Boeing aircraft, for example, and billions in U.S. defense spending. Boeing building 100 aircraft, that's a big deal, and that's going to create a lot of jobs for U.S. manufacturers and U.S. citizens. The biggest deal so far to date, though, is the EU deal. And it follows much along similar lines. Some people were saying that the EU, being a similar size in economic strength as the US as a combined effort, they were going to negotiate a better deal because they had similar economic strength as a group, that they would be able to negotiate a better deal. Well, it turns out no. And the reason is Germany has been deindustrializing. France is internally has all kinds of problems economically. Italy and Spain are buried in debt. I mean, you think we have debt? It's worse there. So the EU really, really needs the US economically. They do sell a lot of products into the United States, and they're economically weak at this point. They've done much of it to themselves, frankly, but they were in no position to be able to wage a trade war with the US. We would have won big time. They knew it. Also, because, again, previous administrations, we've never seen a president that was a business thinker like this. They were politicians. They were not business people. It wasn't that they just didn't, I don't know if they didn't know or what. It just was not an area of expertise or interest or even paid attention. But frankly, Trump was right that these countries have determined that a 15% tariff is far better, and investments into our country, many of these investments into our country. For example, EU is going to invest 1.4 trillion, by the way. Over 750 billion of that is going into American energy. It's a massive amount of money. And as they put it, Japan, EU, South Korea, and others, these are in essence buy downs on the tariff rate. Trump had threatened 25, 30% tariffs on many of these countries. And with the EU, in fact, he even stated, if we don't agree to a deal, he's going to raise the tariffs to 50%. Again, that was something that Europe could not afford. And by investing the 1.4 trillion, for example, from EU into the United States, in effect, it's a buy down of their tariff rate. Now, here's what's interesting about this. Obviously, we don't know what kind of profits, what kind of profit margin many of these countries and companies were making on the U.S. with our low tariffs we were charging and the high tariffs they were charging us. But clearly, they've determined a 15% rate is low enough that they can do business, still make a profit, yet not raise prices to the end consumer. So again, it's a win-win for the U.S. consumer. We'll still get access to these products. Much more tariff income. We're talking hundreds of billions of dollars. In fact, the first time in a long time, the month of June of 2025, the U.S. government had a surplus for the month. In other words, they actually received more than they spent. We haven't seen that in a long time. And much of it was because of the dramatically increasing tariff revenue. And we haven't seen nothing yet, folks, because these deals haven't even been settled yet. We're going to start to see significant more of this as we go forward. My point is simple. Previously, these other countries had tremendous deals with the United States. Obviously, they were making probably obscene profits, frankly. In fact, it kind of does explain why Europe, for example, was able to offer free medical, free college, and all these things. It's pretty easy when you're making tons and tons of money on the U.S. consumer through their tariff income. And by the way, the U.S. was paying 70% of NATO, so we were footing the bill for the majority of their defense spending. So if somebody, obviously Japan the same way, if someone else is paying for your defense or most of it, and you're making money hand over fist, you can afford to pay for medical care for your people and free at college and things like that. The reality is the U.S. citizens were paying for Europeans' medical and educational benefits. That was the reality. Trump was right. We were getting ripped off. We were getting taken advantage of, and there was nobody previously that was willing to take on that challenge and do something about it to fix it. But if you're going back to the EU, for example, why were they so weak? Well, part of it is because they have increased their energy prices on themselves by tremendous amounts by following this green energy projects. They pursued them far more than the U.S. has. And for example, the EU, the energy prices for the average household now runs anywhere from about 5% upwards of 20% of their average annual income. Think about what you make gross in a year and as a household. And imagine paying 5, 10, 15, even 20% of that income just for energy. We're talking fuel, electricity, stuff like that, just to heat your house in the winter and keep it cool in the summer. And that's not money you can invest or do anything with in the future. It's just to keep your living conditions so you don't sweat too much in the summer, freeze to death in the winter, right? So, although some people are saying, it was a bad deal for Europe, they put themselves in this position. The reality is, and they were making obviously significant profits on us. They clearly have determined that now they're going to have a good deal instead of an amazing deal. And that's okay. There's nothing wrong with them making some money, of course, but there's no reason they need to take advantage. And they were our allies. They were supposed to be, at least. Now, the thing that a lot of people are missing, though, is in these deals, there's certain sectors that have received exemptions, and many of those are things like aircraft, semiconductors, critical chemicals, and some agricultural products. What this has done is it's not random. They're creating strategic supply chains on these specific products. So we're becoming true trade partners rather than a dependent relationship, like NATO being, for example, where the US was paying 70% of the defense costs for Europe, and they were only covering less than 30%. So again, we're going to have partners in infrastructure, defense, trade, all those things, instead of dependency. And this is good. It's good for both sides. You don't want weak partners. You want strong partners. I mean, if we look at the GDP of Europe, for example, they have not grown. GDP capita has not grown since 2008. It's the same today as it was back in '08. The US economy has grown since then. We've had our ups and downs at times, but it's definitely been on an upward trajectory. Europe has not. It's been a flat. So this might give them a boost, an incentive. It may be helpful. Again, they may not be as profitable as they were. They're not taking advantage, but they're still going to be profitable. Now, this is going to cause some tremendous change economically. Long term, frankly, a lot of reasons to be optimistic. The challenges are, how do you take advantage of this? Well, when you have a stock market already at all-time highs, certainly can go up from here, but I would be a lot more sanguine about the markets if we had some room to grow, not starting at the all-time highs already. That means, most people agree, because we have structural change to our economies that we haven't seen in a lifetime. There's going to be some volatility. Even Trump said there's going to be some transition. You don't make these kind of big changes without fits and starts. These deals are great. Implementation of the deals at times are going to cause some challenges, some roadblocks. There's going to be volatility. And again, when you're at the high end of the spectrum, the high end of the market, for example, your risk to volatility, the downside is much, much greater. How do you take advantage? Two ways I see, actively or passively. If you want to actively do so, your personal banks are a great fit. Put the money in the policy, highly liquid, insured, guaranteed, tax-free. And when the markets take a dive or adjustment or whatever, inevitably something will happen. You can jump in and take advantage. Or passively, annuities could be a great fit because you can have unlimited upside growth with no downside risk. They guarantee the principal. We're seeing the best annuity products that have been available in over 40 years. It's a golden age of fixed assets. So if you're interested in learning how to take advantage of this economic boom we're going to see over the next few years, yet there's going to be transition and you don't want to be at too much risk to that, contact me at yourpersonalbank.com. Stay tuned in the next segment. I'm going to share some more about some of the trade deals and how it'll affect us. Don't miss it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. It's amazing how fast these trade deals have come along. When you think about just a few months ago, we were staring at potential trade wars. The markets were crashing. There were a lot of economists and experts predicting recession, doom and gloom, all kinds of stuff. Even on this show, I said the potential for recession certainly did exist. It was definitely there because if we got into a trade war situation, it could get really ugly really quick. Now, these deals that have been made now with Japan, South Korea, EU, and others have been tremendous. Even the most negative Trump person, I've heard some of them come out and they're like, got to give him his due. These are amazing deals, tremendously beneficial to the United States, far better than anything we have seen in like 90 years. Literally, this is amazing what's happening. Now, we're not out of the woods yet completely. Again, reason for optimism, no question. One, transition. When you're making these kinds of changes, we're talking massive, massive structural change to the economic system, going from a service-based economy that's, been devastated from manufacturing from, say, 30, 40 years ago, back to that, and all the changes with the tariff policies and everything else. There's going to be fits and starts and ups and downs, and countries that are committing to these amounts may not be able to come through or come through in the time frame that they say they are. All kinds of stuff can happen. Implementation, I mean, we all know this. You build a house, you assume or you're doing a remodel or something like that. Anybody's ever dealt with anything like that? We all know that the contractor will come in and say, hey, this project will be done in 6 months or a year or whatever the time frame, and it'll cost this amount. I always tell people, plan on doubling the time frame and at least add 20 to 30% to the bill, because the reality is it's going to cost more and take longer than you think. Think about that on a scale that's almost unimaginable. We're talking about literally now trillions of dollars altogether from multiple countries, dozens of countries, all kinds of players involved. Stuff's going to happen. There's going to be delays. There's going to be problems. There's going to be misunderstandings. There's going to be fraud. There's going to be, all these, this is human nature. Stuff's going to happen. In the long run, again, am I optimistic? Absolutely. Is it going to be better than what we had before? Absolutely. Getting there will be the challenge and the interesting ride. So expect some volatility. I believe, and especially given the fact that we're at the high end of the stock market, volatility is certainly a bigger risk at the higher end than the lower end. You could see some massive, significant changes when some of these things that, hey, the euphoria of the deal came out, this is great, woohoo, and then reality hits and we get delays, challenges, whatever. So again, I'm positive about the future, but be careful on the road getting there, especially the first year or two. It's going to be interesting as this is all new. It's all new for us. It's new for them. It's new for everybody, really. And one of the common themes, though, that I like about how this is playing out is, in general, Trump came in with a high number. Most of these countries, 25, 30% tariffs. The EU couldn't afford that. Neither could Japan, obviously. They figured that out. But by committing to invest into the United States, and understand, EU, Japan, they were going to buy energy from somewhere. Well, by committing to doing it to the United States, we benefit as a country. We have a lot of energy to sell, and it'll in effect allow them to buy down their tariff rate. And lastly, probably maybe one of the most important things, it makes us strategic partners. So they're buying our goods and services, our energy, whatever it may be. And it's literally a joint venture where Japan puts up the money. We get 90% of the profit, but they get 10%. And we own this jointly, the two countries. That's pretty awesome. That's a long-term strategic partnership. And that's what a lot of these things are doing. And that's also why we're seeing opening up of these markets in the EU, Japan, South Korea, other places, opening markets to U.S. products that were never previously opened before. That's going to open up markets to our companies that never existed before. And their market share and their ability to be profitable is going to be even bigger. We're going to create more product, more stuff. It's going to be good all around. All right. And it kind of goes along again with that same theme. If you remember, not too long ago, Trump got the European countries and NATO to increase their funding up to the 2% that was originally they were supposed to do. Most countries were not even funding 2% of their GDP. And recently now, because of everything that's been going on, he's got them all to agree to increase it to 5% of their GDP, which means instead of the United States providing over 70% of the total funding for NATO, and all of Europe, all of the rest of NATO contributing less than 30%, well, now it's going to be far more balanced, and they're going to be far more partners instead of a dependency scenario. And that's really what it was. We were the big kid on the block, and they were all dependent on us for their defense. By the way, this is also going to create another paradigm shift. There's a lot of people out there talking about, well, we should have free healthcare, free college funding, education like Europe does, etc. Well, when another country is funding the majority of your defense spending, and through trade deals, tariffs, you're making obscene profits or money hand over fist, it's a lot easier for the country to fund healthcare, free college, stuff like that. Also, most of those countries, their tax rates are far higher than the United States too. So when you add all that up, they're taxing more. Most of their defense spending was being covered by the U.S. citizens. By the way, where does the money come from the government, U.S. government? From the citizens who pay the taxes, right? Or they print more and it creates more inflation. We all end up paying more anyway. So through increased costs of goods and services that we have had to pay through inflation and money we've had to contribute to the government by force, we have basically funded, for the most part, Europe's healthcare and their free college. It'll be interesting to see now that they're having to pony up more of their own. Again, they're not being so dependent. They're independent countries. They're wealthy countries. They should be responsible for their stuff and their people. They shouldn't rely and be taking advantage of their so-called allies, the United States, to foot most of the bill. It'll be interesting to see how this whole free healthcare, free education stuff continues, because the governments are going to have to fund more of their revenues towards defense and selling products, tariffs to the U.S. It's going to be quite interesting to see what happens. You see, the heart of these negotiations, these trade deals, is not just market access or investments. See, at the heart of these trade deals is leveraging strategically with trusted allies, and those working together, creating long-term economic strategic partnerships. This is good. A lot of focus on national security issues like semiconductors, critical minerals, and it puts investment not just and market access at the heart of the negotiations, so that it's more of a fair trade, not free trade. The whole thing we're always told for decades is free trade is good. Well, I agree. Free trade is good if both parties are working on a similar footing and are both not playing games with the other side. Unfortunately, most of these countries, many of them are allies, were doing some of the worst, were taking advantage of the situation where U.S. would have little or no tariffs on products and they would tariff us significantly on our products or even restrict them completely. Well, that's all changing. It's all going away, and it's going instead, again, from a free trade scenario to a fair trade scenario. And one of the terms they're using is, instead of calling it traditional trade, they're calling it co-created platforms for industrial renewal. I kind of like that. Again, they're pooling capital together, shared resilience, shared strategic partnerships. That is really, really kind of cool if you think about it. And this is this kind of cooperation with allies, with EU, Japan, South Korea, and other allies. You know, it's going to create a future long-term cooperation, deep, long-lasting, trust, long-term commitments, long-term risk sharing. You know, tons of capital will become available for, critical technologies, all this type of stuff. And really what this does in a big way is it really, really puts China's Belt and Road Initiative underwater. Because the reality is China has been taking advantage of many countries around the world by offering infrastructure investment and then basically lording over that country and creating high interest, high debt situations and basically master slave kind of scenarios. China would come in with the money desperately needed for infrastructure and then lord it over them, if you know what I'm saying, a way to control that country. Well, if you were a smaller country and you had a choice now, you're seeing what's going on. You need some help with infrastructure, and you could work with China, and then you can see repeatedly that they're going to put you in a massive debt situation and put you in a situation where they're the master, you're the slave. They're in control, you're not. Or you can work with the U.S. in a cooperative joint venture type of agreement with both parties receive gains, both parties will get profits. I mean, that's a pretty easy decision, isn't it? So it's not only for economic reasons, it's for national security reasons. It will draw many, many countries that might have been on the fence to the U.S. sphere of influence, working together economically, strategic partnerships. I mean, I can't say enough good. This is all good. This is all a very, very good development that we're seeing. Now, the big question mark out there still is there's no deal with China yet. I know they say they're discussing with them, they're talking. That's good. We got to wait and see what the Chinese, because that's the big one. I mean, the EU is really big, no question, but China will be bigger. And that's the big one. So that's the one where we have to kind of see, hopefully, so far so good, that one comes through. And if that one comes through in a positive way, then we can really see something going forward. But again, I caution, as much excitement as there is, and there's a lot to be excited about and optimistic about. Infrastructure is just one of those things. You're talking about builders, you're talking about contractors, you're talking about delays, construction delays, difficulty. I mean, it never... When you build something, it never, ever, hardly ever goes as planned. There's delays, there's cost overruns. I mean, those things are going to happen. We're going to have some ups and downs. We're going to have some volatility. You want to take advantage of the opportunity that I believe the U.S. economy is going to see probably more than we've seen in any of our lifetimes, frankly. Yet there's certainly risk of volatility. The market, again, I'd be a lot more sanguine if the market had some room to had been down a little bit and had some room to go, but it's sitting there already at all-time highs. You can go up from here, but it can certainly have a lot of volatility, and not everybody has the stomach for that. Well, again, I see two ways of doing it, passively or actively. The passive way would be set up an annuity, man. It's guaranteed you'd have unlimited upside growth, just like you have in the markets and indexes, with no downside risk. I did a review with a client just yesterday where last year she earned 19.85% return on her annuity. And the best part, this was the part she liked the most. I mean, she liked the return, don't get me wrong. But the best part was I told her, hey, this is locked in. So if the market goes down next year or in the future, this gain you just received, you will never lose. That's your new principal. Well, that's not true in the market in general. You invest in mutual funds or other assets, stocks, whatever, they can go up, no question, but they certainly can go down, and you can lose some, if not all, of the benefit you got previously. That doesn't happen with an annuity. And we're seeing the best numbers we've seen in over 40 years. Great time to look at that. The active way would be your personal bank, put it in, insured, guaranteed, tax-free, highly liquid. When the market took an adjustment, you access from it, invest, and get positive arbitrage on the money. Tremendous way also of building wealth and reducing or eliminating that downside. Take advantage of the upside while eliminating the downside. That's the beauty of these products. If you want more information, contact me at yourpersonalbank.com. I have some more information on the trade deals or some things going on that I think you'll find very interesting, so stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So as much reason as there to be optimistic about many of these trade deals, we still have some challenges to deal with in the meantime, and we can't ignore that. I don't want to, there's lots of good news, certainly, but there's also challenges. And one of those is some of the people that we still have in charge in different areas of government and things like that are frankly just not looking out for the best interests of the American people. It's quite obvious. And perfect example of this is recently California did something called Fire Aid. So they had this huge event, brought in a bunch of celebrities, raised a bunch of money, a charitable event. Apparently they raised about $100 million. And the purpose of this was supposedly to go to the people that lost everything, lost their homes, in the fires that happened recently. Well, it turns out that none of the money so far has gone to any of the people that lost their homes. In fact, it appears that the $100 million raised for the Los Angeles fire victims was funneled to over 188 NGOs. These are non-governmental associations, many who are totally unrelated to the fire. One, in fact, was a musicians charity, and another one whose NGO's whole entire job is to raise money for other NGOs. In my opinion, basically Gavin Newsom and those who were in charge of this program stole the money. They basically raised money, ostensibly for charity to help people, yet they didn't help the people that they were raising the money for at all. They basically sent it to their buddies, their friends, and you and I both know some of that's going to get kicked back to them. I mean, that's the system. That's how it works. Look, I can't prove that, but I think any person with common sense understands that why would Gavin Newsom and other politicians like that raise $100 million for charity, give it to 188 organizations, some have nothing to do with fire? It's because they're going to get some benefit from it. It just, connect the dots, folks. You know what I'm saying? It's not that complicated. By the way, this isn't the first time Gavin Newsom has done something like this. In fact, no one knows where the $100 billion for the high-speed rail is gone, and they laid like hardly anything was built. California raised $37 billion to take care of homelessness, and there's more homeless people than ever. They raised another $40 billion for affordable housing, yet there is none. They raised $5 billion for water storage, yet they still keep shooting it out into the ocean. Nothing's been done there. So again, these are things that happen consistently, repeatedly. And the fact that people continue to re-elect these kind of people who have done nothing really but just take advantage of the situation is disappointing. If enough people wake up, finally, maybe it'll change. But these are the kind of folks as I call it, they're dug in like a tick on a dog. They're sucking on the system, and they've been benefiting from this for decades, many of them. And to pry them loose like that tick, it's going to be tough. And those are the people that will slow down, make things difficult, as I was stating here earlier, create problems, delays, complications, and that's where we get volatility because things don't work out or take longer or whatever. So another bit of good news here. GDP for the second quarter of 2025 came out at 3%, which was better than expected. Now, in general, the economy is looking pretty good. Inflation still slightly higher than the Federal Reserve's target of 2%, but it's not too bad. It's about 2.5-ish, that kind of range. Interest rates are a little higher than the long-term average, but not overly so, frankly. And there is quite a bit of expectation. It's increasing that the Fed will likely lower rates at least a little bit before the end of the year, so that could help some. Now, the stock market, as I stated earlier, at or near all-time highs, which is really good if you're invested, got in earlier, but if you're trying to get in, it's bad. So it depends on what side of the fence you're on. Real estate, again, near at all-time highs. It's coming down in some areas, but in general, again, good if you invested previously some years ago, but bad if you're trying to buy a home, if you're trying to get in. So that's, again, it's like a bifurcated economy. Are you one that was in earlier and got to take advantage and benefit from this stuff? But the other one is the debt. The debt is still definitely a significant problem. Now, there is a lot of reasons to be frustrated because, for example, U.S. government, Congress has increased spending 53% since pre-COVID, yet at the same time, the U.S. population has increased about 2%. I just asked a simple question. Why do we need to spend 50% more money when we only have 2% more people? I mean, before COVID, we had roads, we had a military, we had everything we needed. I mean, it wasn't perfect, but we had what we needed. Why do we need to spend 50% more? Again, a lot of it is waste, fraud, abuse. Trump administration and Doge have been trying to do a lot to alleviate some of that, but it's been a hard slog. That's what I'm trying to say. That's a perfect example of all this investment, infrastructure investment with these other countries and all. It's all great. But look at how hard it is to say get government spending down through Doge and how much they fight back. Congress, for the most part, just refuses to meaningfully reduce spending. I'll give you an example. The Big Beautiful Bill was the largest spending cut in the history of the United States. Now, on the surface, that sounds great. But then you find out the overall total spending only decreased by 2% over 10 years. Congress has increased spending by over 50% since pre-COVID, yet we have 2% more people, that's it, and they fought tooth and nail to get a 2% spending cut over a decade. Now, again, it's a step in the right direction, but frankly, that's kind of pathetic. I mean, gosh, couldn't we at least cut half of that back? A 25% cut? We increased spending by 50%. Why couldn't we cut back 25? Gets you an idea how hard it is to get Congress and people to agree to spend less, especially when they get used to it. They get used to the spending. Now, when you look at the CBO charts, this is a Congressional Budget Office, where they do long-term planning charts of the debt. And I've been one of those too that's been discussing how the increase in debt is unsustainable. And it is. There's no question. Interest on the debt keeps increasing. But I did learn something recently that I was not aware of. Really, you got to dig deep for this. But it turns out that the CBO numbers are estimating a 1.7% GDP growth. In other words, that's the growth or income increase of the United States. Now, if you look at that based on a 1.7% average GDP growth, there is absolutely no question that the debt spirals out of control. As I shared a couple of shows ago, one of the most advanced computer models that have probably ever been done predicted that we would go into a debt spiral in about 20 years. You look at all the charts, it kind of shares the same thing. Here's what I learned different, and it gives us all a reason for optimism. The long-term average GDP growth for the United States is about 3%, about 3 to 3.5. Again, over the last century or so. This is long-term. Now, recently, we haven't seen that type of growth, but Trump first administration, we did see that. The GDP numbers hitting this past quarter at 3% are pretty impressive, especially given the fact, and most of it is because increased tariff income. It's impressive because most of the deals and stuff, like I said, had not really taken effect yet. When we start seeing significantly more investment into the United States, as these countries are pledging to do. I mean, we're seeing numbers upwards of $15 trillion, folks. That's about half of our total debt over the next, say, 4 years. That's a stupendous amount of money. In fact, if you want to put it in perspective, you take all of Silicon Valley, all these big tech companies, you put them all together, they're probably worth about 11 trillion. So this is actually more than all of Silicon Valley combined additional infrastructure investment. This is massive. So it's, like I said, the long-term upside potential is amazing. Now, if we can get GDP growth to 3% average, in fact, what that does is it flattens the curve on the increased debt, the interest on the debt. So even if we do not decrease spending, but we get increased growth, we can kind of flatten the curve and stop the increase in the percent of a GDP. In other words, we owe about 120% right now of what we earn as a country. It'll stop increasing. Now, that amount of debt's not a great thing, but at least increasing of it will stop. And that is a good thing. If GDP increases to 3.5%, we can actually start to see the debt to GDP ratio, or debt to income, maybe a better way to put it, start to go down. Trump understands this intuitively. And that is why he's been pushing so hard for all these deals, because I think he's realized, it's obvious, reducing spending, yes, still do it whenever possible. Some of these recession packages are reducing spending here and there, at least a little bit. Everywhere you can cut helps. But if you can massively increase income, you can also eliminate a debt problem. It takes a while, but in a couple of decades, instead of going into a debt spiral, a death row, if you will, where the majority of the government income is just interest on the debt, we could actually be in a healthier financial position as a country than we are today. So notice you can grow your way out of debt, bring it down to a household budget or business. If you have a debt problem, you have two solutions. You can earn more money or reduce spending, or the third one is do both. And that's kind of what they're working on, but they're really pushing the growth side more. And that one's more palatable. Everyone likes growth. That one's easy. Cutting spending, that's politically difficult. As I shared in the previous segments, a lot of reason to be optimistic for the longer term future, but certainly likely a lot of volatility in the process of getting there. If you've ever done a remodel or built a house, you know what I'm talking about. Projects invariably take longer and are more expensive. And we're talking about the largest infrastructure project here now with all these investments in the history of the world. There are going to be delays, challenges, problems, and that can certainly cause some volatility in the markets. They could go up, they could go down. You're at the high end of the market, so you can see more exaggerated moves. If you want to take advantage of the upside potential that I clearly believe is there, but limit or eliminate your downside, look at your personal bank or an annuity. Annuities can do unlimited upside growth with no downside risk. I've shared this before. I've had several clients earning 20% this past year on their annuities, last couple of years, in fact. And if the markets take a correction, those gains are locked in. They're not going to go backwards. Did a review yesterday with a client where she had 19.85% return on her annuity last year. And if the market goes down, she doesn't lose a dime because those gains are locked in each year. That's powerful. That's a really nice passive way to grow your money safely, yet take advantage of tremendous upside potential. If you want to be more active, your personal bank allows you to grow your money insured, guaranteed, tax-free, highly liquid, positive arbitrage. You can access funds. You can let it grow when you see opportunity, take money from it, access it, buy the asset at a discounted price, and really take advantage and still earn positive arbitrage. If you want to learn more, contact me at yourpersonalbank.com. Stay tuned. Last segment, I got a few more things to share with you I think you'll find extremely interesting.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So this tariff revenue that we're starting to receive is coming in so fast, people are having a hard time keeping up. A few weeks ago, it was projected that the US would receive a little over 100 billion of tariff income by the end of 2025. Now the projections are over 700 billion. That's like a seven-fold increase of expected tariff income just in 2025. And as some people pointed out, let's just say that is where it stays. It's probably going to be higher, but in the next decade, that's over $7 trillion of additional income that our government was not receiving previously. June of 2025 was the first month in a long time where the revenues for the US government was greater than expenses. In other words, they were in the black for once, mostly primarily because of the tariff revenue. Also, second quarter GDP numbers came out. It's better than expected at 3%. If our economy can grow at about 3 to 3.5% annually, longer term, we can flatten the curve on this debt interest problem. That's the big problem we're dealing with. If we can continue to grow, we can grow our way out of this. Now, it'll take a couple decades or so, don't get me wrong, but the alternative is not appealing, because if we don't do this, if we don't grow our way out of the debt and we don't reduce spending, we could end up in a debt death spiral, they call it. And that's where you basically, the interest on your debt is so great you can't support it anymore. In effect, you're bankrupt. And when countries do that, it's not pretty. There's a lot of people who say, what's going to happen? A lot of projections. Bottom line is none of the options are good. So the best way to do it is, the easiest is to grow our way out of it, or the most palatable, I'll put it that way. No one's against growth. Most people are in favor of growth. It's good for everybody. Everybody makes more money. The economy's better. I mean, all that's good stuff. It's hard to argue with that. Cutting spending, although good for you, a lot tougher pill to swallow. Particularly politically it is. Congress is dug in. It's really hard to get them to cut spending very much. And like I said, once people get used to the spending and benefiting from that, which many of them are, again, it's like a tick on a hound that's been dug in. It's really hard to get them out. So we should absolutely continue to pursue, and I like what the Trump administration is doing in that regard in terms of reducing spending, recession packages, reduce spending. Gosh, imagine if we could reduce spending some and grow. We could get ourselves out of this threat of a death spiral that's kind of hanging over our heads like the sword of Damocles. We could get that out of the way in the next decade or so. It could be done. And our country's done big things like that before. Now, here's some of the challenges. Again, it's not all rosy. I've said this many times, even Trump has said, it's just going to be a transition period. This is a massive, massive structural change to the economic system that we had before. It's changing the infrastructure. It's changing the supply chain. It's changing the manufacturing. It's changing everything. And when you're building something, it's rare that you come in on time and under budget. Can happen, but it's really rare. You typically run into delays, cost overruns, you run into problems. Part of the reason why is not everybody's on board with this growth, grow our way out of the debt, because there are some people out there, some people call them the elites or whatever, some people politically that have benefited from the situation, the status quo. I mean, why do you think they pursued it for decades, where trade policy was very one-sided? The other countries benefited while the U.S. didn't. Having a lot of debt benefited a number of people in this country, some politicians. That's a fact. And they're going to fight hard to keep the status quo. It's not going to go in a straight line, because you're going to have some people, it's going to be some push and pull. And you want to take advantage of the upside, no question, but how do you protect yourself from the downside? We have products that do that. Your personal bank, annuities, best time in 40 plus years. I've shared that many times. Let me share some other causes for concern, things you need to be aware of. Well, it turns out Bank of America just put out a massive warning stating that we're in a bubble bigger than the dot-com crash. They stated that 38% of the S&P 500 is concentrated in just 10 companies, and PE ratios hit 27 times versus 25 times in 2000, which was the height of the dot-com, which then later crashed. That one dropped 45% top to bottom. By the way, I know, I was there. This is my 25th year in the financial industry. I like to say I've been on this rodeo before, in fact, 3 times. We're not at healthy numbers in terms of the stock market. There's a lot of optimism in the markets right now. A lot of it is because of AI and the amount of money that's going into that. Now some of it's starting to come in because of the trade deals and the investment in the infrastructure. Personally, I'm probably more optimistic about the trade deals and the investment into our country from these other companies, because that's going to happen much sooner in the shorter term, like in the next 1, 2, 3, 4 years. AI is sort of an unknown in terms of when will it really have a significant impact. It's having an impact, don't get me wrong. I saw this with the internet.com. We saw that huge bubble and then burst. And then part of the primary reason why that bubble burst, I mean, it went up for the same reasons. There was a ton of optimism that the internet was going to have a massive impact on the economic future. And it did. The problem was it took a lot longer than people thought it would. I mean, there were a lot of promises made from Silicon Valley, a lot of young, hard charging entrepreneurs. They tend to exaggerate, okay? They tend to get excited. Wall Street does too. Fear and greed, all these things come into play. Look, AI may come into play in the shorter time frame, like some have been predicting. The more likelihood scenario is it'll take a lot longer to make the impact than we're being promised. I'll put it that way. And part of the reason is, hey, if you have an AI company or involved with that, you have to raise a lot of money. You have to have a lot of optimism. You have to sell your story. You know what I'm saying? And you want to make it very positive, and you want to make it where investors want to invest, venture capital, whatever. They're going to buy your story. And so you have the incentive to embellish the story, if you know what I'm trying to say, and make it sound a little better than maybe it's really going to be, or shorter time frames. You know, much like a contractor, when you come in to do a remodel, build a home for you, if they tell you it's going to take longer and cost more, you're less likely to choose them or as a contractor than if somebody else is going to come in and tell you a shorter time frame and a cheaper price. The contracting industry is famous for that, and they know this because when they do an estimate, they'll cut it by about 20% to get the job, because they know, and also the time frame estimates, because they know once you contract them and you get started and then you're in the middle of the project and then there's a delay or problem, it's unlikely you're going to stop and switch and go to somebody else. You're going to come up with the extra money and you're going to deal with the extra time and pay them and get it done. That's real world. Here's some of the other challenges that we're dealing with. For example, all this inflation that we've dealt with over the past few years is really taking a bite on people and is hurting them. For example, even higher income Americans are now increasingly falling behind on debt payments. Delinquencies on credit cards and auto loan debts from Americans making up to $150,000 a year have jumped 18% over the past 2 years. Lower income borrowers have seen increases of over 8% in auto loan delinquencies and 2.5% in credit cards. The share of Americans making late credit card payments in the higher income zip codes has now surged twice as much as the lower income zip codes. This is starting to hit the middle class and a little bit upper middle class even. And this is all while it's going into a weakening labor market. I think the longer term, there'll be more jobs and all, but we've got to get through this transition period. Another factor that's come about is this whole buy now, pay later phenomenon. A lot of people are not aware of this. It's getting much more common for people to buy now and pay later. The amount of volume of that occurring since 2022 has increased 7 times. And a recent Lending Tree survey showed that about 25% of buy now, pay later users are now using that to buy groceries, which is up sharply from about 14% last year. The higher cost of food and everything else out there, necessities, is really putting a crunch on people. Record levels of debt. Credit card debt is at all-time highs. People are borrowing more and more money, and this is not a good scenario to be in. They're trying to hang on until things get better. I'm optimistic about things getting better, but it may take longer than you think. So hopefully they can hang on long enough. But regardless, more and more of their income is going to interest and debt. Over the past couple of years, job openings have been declining quite rapidly into what many would consider recession areas. There's a lot of reasons of optimism, yet at the same time, there's reasons to be concerned. It's going to be an interesting ride. There's opportunities that are going to come. You want to take advantage of those, but don't put yourself in a position where you're at risk, where you could lose a significant portion, for example, of your portfolio, because a lot of volatility is going to likely occur along with this transition. That's just common sense. And the fact that you have products like annuities that allow you unlimited upside gains without the downside loss. They protect the downside. And we're seeing the best numbers we've seen in 40 plus years. My gosh, it's time to look at it. Contact me, yourpersonalbank.com. The one negative you get from annuities, for example, is, well, you have to tie your money up. There's early surrender penalties. Even those oftentimes are now going away because many of these products have something called a market value adjustment. I shared this last week, got a lot of feedback, so I really appreciate that, folks reaching out to me. But a market value adjustment just means that the company has an estimate of how much they think they're going to make profit-wise on the investment. You give them money, they invest it, obviously. If they do better than expected, it reduces your surrender fee or the cost of getting out if you wanted to close and go elsewhere. And if they do worse than expected, it could increase your surrender. Well, here's the thing, because of the higher interest rates and all that, and these companies are now, because of the higher bond yields, we've talked about this many times on the show, that's not going away anytime soon. I mean, at least for the next 5-10 years, if not longer. These companies are far more profitable. We're talking about 2-3 times more profitable than they were even a couple, 3 years ago. That's why the annuities today are so much better than the ones 2-3 years old or older. If you have one of those, strongly recommend contacting me to compare. I'll give you an example. I did a review this week with a client that had an annuity a year ago. It was a 10-year annuity. Normally you'd have a surrender schedule like 10, 9, 8, 7, so forth. First 10% is free, but anything over that. Well, their market value adjustment was so much to the positive that if they got out today, they would take more money out. They would have more money than what they invested. So those are 100% liquid in just 1 year. And I'm seeing this over and over and over again now. We're going to see this a lot going forward. So a lot of these annuities we're doing now not only have better returns than ever, unlimited upside with no downside risk, but you're fully liquid within a year or two. I mean, this is amazing. It's again, best time in over 40 years, golden age of fixed assets. This one couple, for example, they put in $144,000 a year ago. They got a little over 8% return on their money, but also their market value adjustment. In other words, their surrender schedule to get out early went up $7,000 more than they put in. They put in $144 a year ago. They could have walked away with $151 today, 1 year later. So the one negative, the tying up your money for long term with annuities, is largely going away because these companies are so much more profitable. Interest rates are higher. I just can't say it enough. There's never been a better time to invest in an annuity, to take advantage of the high upside potential, which certainly there's a lot of upside potential in the longer term with all these trade deals and everything that's going on with the economy. There's certainly likely a lot of volatility. And if you just don't have the stomach for it, or you don't want to deal with it, you want the gains without the downside, and you want to be able to have the liquidity likely within a year or two, you really should look at an annuity. Your personal banks also, some of the best numbers we've seen, high liquidity, tax-free, gives you opportunity to take advantage of market adjustments in the future so you could buy at a discount and really grow your wealth and really take advantage of these opportunities that are very, very much going to be happening going forward. I'm not going to bet against, I wouldn't bet against America, and certainly I wouldn't now, longer term. We got to get through this shorter term period, this transition period. I'm going to encourage you to stay tuned next week to the Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.